Hi, this is Theo from electrofx.com. Welcome to this fourth video in my free video series. What I'm going to do in this video is just take a look at everything that's been taught so far, but on a different currency pair and using this two chart layout. The way I want to do this is I'm going to do one pass just looking at these two wave scales and the trades available to us, and then I want to do another pass and start talking about that third wave, which you can often see within this H4 chart. And also, right now we've been focusing on one type of swing trade with good risk reward and a good location with good market structure and a nice entry trigger. I also want to introduce another concept which I call a high-low breakout, and it really plays into using that third wave level down. So for now, let's start off with the first pass. We have this green line on the daily chart which signifies where this H4 chart is picking up from, and at the beginning of our chart we have information available that is a very strong downtrend on the daily, and we've just had another strong push here on the H4 chart. So what we're waiting for at this point in time is a pullback sell. We're not looking to buy against that action right there. So where can it pull back and sell at? Certainly this is a viable area. That's certainly the main one in focus and would be mapped out for you by this box indicator. Another area that has potential is just, we can see here we had a pullback and go, so there's something there, but it's just not very significant. Certainly not significant enough to be mapped out by the box indicator. As price pulls back, obviously we're waiting for a relative pullback on this scale of things that we're watching and trading. And once price pulls back and we have these indecision candles here, none of them trigger, but also it's not a relative pullback at that point, and certainly there's no area to the left of price that we can use anyway. So certainly no way to get roped into any selling at that point. As price pulls back a little further, we have a spike reaction at that point. Still nothing to do, it's not that significant. And we follow that with an inside bar to get you thinking about this area. We look to the left, and the only area that we can see or try and justify is that one there, but once again, as I said, it's not very significant. Once this next bar closes though, you have more information available, and by that I mean we have these two spikes from the same area, which is clearly significant of a double tap on a lower time frame, and it's really kind of boosting the fact that this could very well be the area to trade. The double reaction there certainly boosts the entire entry trigger setup. And so now you do have an entry point, and if it does come down and trigger, then it's going to be using this area, and so therefore you have the risk on the trade. The conservative take profit would be a higher low because we're trading lower highs and lower lows and therefore following the trend, so we can expect a lower low. Targeting a higher low is just a very conservative play. That's certainly how I like to map out the risk reward. We have here a above 1-to-1 risk reward, so the trade is an all systems go. If you wanted to use that momentum trick I mentioned, then we scroll back to this last peak that we had of that wave scale, as you can see, and we just used that high, and we use the high that we're trading because we believe we're correct. And once our trade is heading to take profit and we're looking for a take profit, then it will be a new lower high. So we're using this most recent piece of information based on the fact that we are correct. The other side of the channel, we're just going to use that low that is also a permanent feature on the chart, and now we have an idea of the kind of momentum that we're trading. The steeper these channels are, the less likely it is to get to the other side, in this case the lower side for the sell, but it's still a good idea of how we can gauge the momentum. And so, as I've outlined in the previous videos, we have the option of the conservative take profit, the most optimistic take profit, which would be really down here, and then trying to target somewhere right in the middle, which would be right about here. Let's just mark it out as there. So you have these three options. The most optimistic is not something I use, but it's a good way of mapping this out, and it's up to you if you wanted to use that. The conservative, which is the one I use most frequently, is right there, and the middle ground take profit is right about here. So one of these two are perfectly good take profits to use. This one is assuming the lower low, and this one is just playing it very, very safe, and basically guaranteeing that you'll reach take profit. Okay, so this trade was a success. Entry, stop loss, conservative take profit. The conservative take profit on this play it's a 100 pip trade. So there's 100 pips for a few minutes effort and checking your charts once every 4 hours. As we move along on this picture using these two wave scales, we're not looking to trade any buying waves right here because we just made the lower low. We're actually looking for a pullback sell once again. When price pulls back a relative amount, as it does, and we actually have a candle eats candle pattern, so you have an entry point and a stop loss, but you look to the left and there's no real area to justify it. Plus, as you can see, things are slowing down and not looking as powerful. If there was an area there and the risk reward was good though, this would still be a valid trade. In this case, it's no real valid area and there's no good location for the trade. The structure's good and you have an entry trigger. The entry price and the stop loss, if you were to just use that entry trigger based on the conservative take profit, risk reward looks terrible, so it's best to just wait and exercise patience. The next trade that sets up is actually we pull back to this area and we get this entry trigger forming. So now we have a good price pattern there, which would be a double bottom, and we'll be using that price pattern on this wave scale to turn the one above it, which is of course over here. And that would require you looking to the left of price and making sure that this is a viable area for that longer term wave to potentially turn. And once we roll back into this chart, you've got the setup, and so if you were happy with that area, then that would be your entry, this would be your stop loss, and because everything is now very horizontal, then this is the conservative take profit and this is the most optimistic, and smack bang in the middle is that middle ground. Risk reward on this trade, not very good, plus you're fighting a very strong trend, best to just give that one a miss. Okay, now as we come back up and we react at this point, and you have this entry trigger forming here, you have a double top following the double bottom. So now we are in a range, and whereas you can trade within the range if the risk reward is correct, your probability factor is a little lower than if you were not in a range. So once again, if you want to stay extremely safe, then you have to wait until you get out of this range. You can draw that in or just mentally remember it, and there's only one of two things that you're waiting for. You either want to break out of the bottom, pull back and go, or you want to break out of the top, pull back and go, and you'd be trading that swing or of course this swing. So now as we move along, price burst out of the bottom and you're looking for a pullback sell once again to follow this new fresh directional movement. It kind of paused and reset itself, it thought about it again right there, and we broke out. Now we have fresh direction once again. Once price is pulling back here, the first entry triggers that set up is actually right here. You have this inside bar. You look to the left and there's no real area for the trade. Now one thing that I can see here is that you have all these spikes, and I could really see somebody or some people justifying that as a mirror flip area, and really it wouldn't be anything to be ashamed of. I mean, it does have a little bit of potential, it's just not really following the concept of mirror flips that we're doing on these two scales, of it being the mirror flip of a swing at this level, like a mirror flip of this area for example, or a mirror flip on the top side if we came down there. So it's not quite following suit with what we're doing, but for argument's sake, let's just say that you consider that a mirror flip and you like this trigger and you take it, you take a small loss, alright? And we're going to count that in the scheme of things here. So this trade here, let's just call that a 30 pip loss. We won 100, we lost 30, so we're plus 70. Price then pulls back to a proper area, which is of course these areas here. The box is drawn in for you, the inside bar appears there, and so you have yourself an entry price and you have yourself a stop loss, therefore you know your risk. The conservative take profit is of course here because you're expecting a lower low, so we target a slightly higher low. Risk reward on this trade looks really good, and so this trade is all systems go. Alright. Once we start thinking about the take profit options, then once again we have this high and we have the one that we're trading based on the assumption that we're correct, and we have this low over here. So now you have your way of mapping out this take profit idea, which is the conservative area, the most optimistic area, and then smack bang in the middle is another an area that you would normally use to predict the next lower low. And in this case, because we have that spike there, as you can see, the middle ground option ends up being a precisely equal low, and therefore it remains quite conservative, and really it's not that much of a middle ground. You could seriously shoot for this one or this one and you still consider yourself quite conservative. So two real options on the take profit there. Neither would be incorrect. They're both fine. They both give you a greater than 1-to-1 risk reward on the trade. Entirely up to you, person by person, how you deal with this take profit and how conservative you would like to be. Let me just get rid of the channel. As we move on through this chart, we really don't have any more options to trade. The wave just at this scale, the scale that we're trading, it just continues on down, and then it pulls on back up an equal amount almost, which as you can see then becomes a pullback on this scale. So really you're looking at the wave of this scale to turn and have something like that happen, but on this one that we're watching we really do need a price pattern to turn that one around again. You could certainly trade this pattern that we have right here because it is at a good area and it is still maintaining good price action, so there's nothing wrong with that trade at all. There's a certain way that you could manage this, and we can see a lot of activity here. There's plenty of reason to think that this trade is not going so well and to move your stop loss to break even, but we haven't actually got to the advanced trade management yet, so I don't want to confuse matters. Alright, for now this is a feasible option to be in that trade. Okay, so that's the first pass using the two scales, everything you've learnt so far: location, market structure, nice entry trigger, good risk reward, intelligently following price and sticking with the trend, or attempting to use the price pattern of the H4 to turn this scale of movement on the daily, which is our longer term. When we roll through this again, I just want to sort of enlighten you to the next wave scale down, which you can often see on this chart. It's just a little tidier to have a third chart and monitor it separately, in my opinion. But I mean, here for example you can see a movement within this swing scale. So obviously you can understand now that this trade here becomes a trend continuation swing trade of that lower scale, and really everything you're doing on these two scales you extrapolate from that and just add this third scale. It certainly is a little bit more complicated, but if you understand these concepts completely, it's really not that difficult. Okay, the other thing that I wanted to talk about here, just looking at that smaller scale again real quick though, I mean here you can see what's going on that next scale down. We won't go into that too much right now though, that'll be coming in a separate video. The other type of trading that I'd like to talk about, and that is a very feasible option once you're using that extra third wave scale, is breakout trading. It's something you could also do just using these two charts as well, but it's much better to actually take every trade that you take as a swing trade on some level. And what we have here, for example, is a high-low breakout. Price does not pull back far enough to give us a proper swing trade at this scale, but it does break the low and pull back a little bit and then go again, which actually gives us a bit of a breakout setup. And that means that we can now trade the break of this low and use the high of the miniature pullback that was not a swing at this scale. And then you just target 1-to-1 on these type of trades because it's hard to judge the take profit using those other techniques. Now if you think about that and you think about using a third scale, then as you can see you just end up trading a trend continuation wave on a smaller scale, but based on this trade. The trade is still red from this chart. This is where you decide what type of trade you're in, and then you can have a great reason to trade this trend continuation wave. Okay, so I think that's about it without adding too much too quickly. In the next video I'll introduce that third chart and then the next scale down that you can monitor, and then after that we'll move into some trade management stuff. For now, let's just take a quick look at what happened here. We had the 100 pip trade, then we had the potential for a 30 pip loss putting you at 70, and then you had this next trade here which was 130 pip trade, and this is all using the conservative take profits, of course. That puts you at 200 pips on the conservative side. Certainly if you shop for that middle ground take profit, it would be much greater. And you know, that's really as simple as it is. You can take a look at this on some other pairs by yourself in your own time. Just lay things out this way and have a look at the latest trades that have occurred and how they could be managed. These are certainly not high frequency trades. This is intra-week trading. I mean, you're really just looking for 2 or 3 trades per week per pair. Once you introduce that next level down, you can start thinking about intraday trading and obviously increase your trade frequency. But you know, this is not the most active, not the most exciting way to trade. It's just safe and solid way to intra-week trade. I hope you've enjoyed this video. If you have any comments or questions, feel free to post them on YouTube or in my forum at electrofx.com, and stay tuned for the next video.